Hi folks, it's Aiden CryptoBirb speaking. Welcome to today's Friday webinar. What a beautiful day. However, not everything is going so well in the markets as the whole, as the whole risk sector. For the stocks, for the risk offensive stocks such as the tech, communication services, and whatnot, and also including cryptocurrencies, they all have started tumbling just a little bit after recent dollar pushing through higher. So, what is going to happen next? We're going to talk about this and my next trade that I'm going to take after collecting $200,000 profit over 1 month. Let's see what the market is cooking and giving us today. Stay tuned. Welcome, everybody. Again, this is Adrian CryptoBirb talking to you on this beautiful Friday day. Do you see a lot of smile on my face? Not so much because of the market dipping. I mean, one of the reasons, I'm also happy is because I get the chance to talk to you and teach you a couple of good things and good tricks that could potentially help you in something that we otherwise know as a potential start of a new bull market, right? There has been signals to confirm the new bull market start. Despite those are the early infant stages of this said bull run, the chance and the opportunity is there. Whoever gets to this chance gets and accepts this opportunity, the opportunity earlier in the timeline, they're going to experience better profits, bigger returns. That is the goal. That is the goal worth pursuing for you as a trader in your trading career. So here today, I'm going to talk about Bitcoin, Ethereum, a couple of different FUD reasons, that we're looking at in the markets. Gary Gensler, of course, came up with a couple of SEC regulations, also punishment for cracking, over the unregistered, staking services and so on. So there's been a little bit of headwinds over the past couple of days. The stocks also plummeted slightly, or not so much slightly, right? Because a couple of percent is not so much popular to so many risk assets outside of cryptocurrencies. It's only on cryptocurrencies you see such a huge volatility that the 5% drop doesn't kind of like impress you anymore. However, for anything that outside of cryptocurrencies, 5% is a significant drop in value, and lots of those risk assets, risk offensive stocks actually did plummet like that. So we're going to talk about this and more, and let's kick it off with my trade, right? Because like I said, over the past 30 days, I was lucky to close a trade of $200,000. Well, call it luck or not, right? Because there is a little bit of discipline in that. I'm a trend follower. I'm following my trend following system, and any system kind of like is a compromise, is your decision whether you prefer the reliability with the high win rate or better profits, right? So you cannot get high win rate and high profits. It's either one or another. So I choose the actual high profits coming from the long lasting tails in the market, so-called trends. Those trends tend to persist whenever they appear. However, they appear infrequently, only 20-30% of the time. Otherwise, the market moves sideways and falling with a lot of chop, with a lot of whipsaws on both sides of the patterns that they form at times within the some sort of like geometrical shapes, triangular forms, and whatnot in the market. So that being said, following my own trend following system, and any single system consists of 6 factors, at least following, just something that we otherwise know as turtle traders, principles, 6 factors that you have to counter and or account for and count in for if you plan on following any system. This is the markets that you trade, which is a specific market. What the exchange is, if you trade on Bybit, for instance, right, or any other exchange, you have to decide about your interests. You have to decide about your exit strategy. You also have to decide about the tactics, what is going to trigger your system, about your protective stops, right, and when you are actually going to commit with a specific risk regime. What is the risk capital amount, the position size, corresponding with the risk control, so that you don't overexpose yourself to risk, you don't overexpose your portfolio to ruin. Otherwise, if you don't follow the 6 principles, the 6 factors for any trading system, the reality is that eventually you will fall into ruin, into financial ruin, because without proper risk control, you're going to face many losses, and those losses are infrequent, in the range. However, if you follow a trend following system, just what I am doing, coming from those longer tails, where I follow the trend when it finally appears, then you have to experience 60-70% of the losing trades. But those losing trades are controlled within a small and tight risk regime, so that even if I lose 1 or 2%, and I lose 6, 5, 7 times in a row, then eventually this large trend comes up, which it did recently, this massive breakout, and I was rallying, Bitcoin from 16,920 all the way up to, 22,800, right? This is a proof. This is coming up with the entry confirmation from my Discord channel, where I posted this trade on the specific date of 7th of January, and the 7th of February. This is where it closed, right? So exactly 30 days. In 30 days, just following this indicator alone of my own BPRO hard time frame trailer system for the trend breakouts, this got me $200,000 profit just alone in the month, right? So I'm really curious what the next move is going to be. Right now, I closed the position mainly because it provided an exit signal, just like you can tell here on the right hand side of the chart of the picture. Once it triggered this bearish kind of like note, right? So I enter whenever it triggers the bullish note on the breakout to the upside in a reliable manner with a confirmed volatility, with a confirmed strike through. Okay, there needs to be this consistent serious signal in order to validate my trade. And whenever this same one, kind of like based on volatility, happens to the downside, right, it cuts off my trade, tells me to close the position, which I did, and actually right after the market dropped and declined to a low 2100s, right? So this is the reality of what a trend following system is going to give you, right? So just having a couple of small losses definitely doesn't outweigh the eventual big profit coming from the longer tail development. And I've been doing that for over a year already with this new kind of like redesigned BPRO trend system that I use consistently, and over a year this definitely helped me basically maintain or not lose 90% of my portfolio, just like most of the crypto traders did over the last year in the bear market, right? So this helped me preserve my capital over the last year. And whenever the things improve, I wait patiently, and just like that, I make up for any single loss that I experienced over the last year. I make up and persist even further with the portfolio performance just beyond that with one single trade. This is the beauty and the nature of trend following. And this is what I, definitely can give you a little bit more insights if you go to my Twitter at crypto_burp, because this is where my trade is listed with proof, with links, with evidence, with transparency, and you can check out the indicator details later in the link that is actually displayed right now in the screen. So otherwise, with a little bit of intro, my job is to give you the understanding that the real trading, not so much of this kind of like stereotypical trading that you see, sitting all over the Wall Street movies, while people, sitting in front of 10 different 20 screen monitors, just, on one call on one hand and never call in second hand, just kind of like buying and selling all at the same time simultaneously. This is all fake. This is all fugazi, right? If you watch The Wolf of Wall Street, one of my favorite movies. And the truth is, the reality is that you have to be ready to experience the losses. Losses are inevitable in this game, right? You cannot escape to have losses. I know we all, as people, as traders, we are loss averse. We're trying to run away from the pain of admitting the losses, of admitting the mistakes, right? However, understanding that the losses will appear inevitably, this is eventual, you cannot escape that. Then accepting that becomes the place that you start, in the spot in your trading career where you start improving, when you start actually making money, right? Because then you know that even though if you have a good system, and such as BPRO, if you have a good trading system or a good indicator that is reliable, that is trustworthy, then even though you face 1, 2, 3, or even 10 sequence of 10 losses in a row, right, which is very, very unlikely, but it happens. Very unlikely means it cannot happen. It means it happens very, very rarely, right? Very rarely, very infrequently. But it still happens. So you have to be ready to experience and to expose yourself to those kind of like losses coming in sequence. But eventually, when the market turns and there is a lot of tailwind for you, the market develops those longer tails in the market, those longer tides, those trends tend to persist because of something that we know as momentum principle. right? Those outperforming assets will continue to outperform. This is a little bit like you perhaps remember the second Newtonian law of dynamics, right? Where when this kind of like when you give a little bit of push to an object, it will continue to move in this direction until, well, whatever kind of like forces will expire there, right? So the same happens within the financial markets. This market as a whole, Bitcoin, USD, kind of like market on Bybit, for instance, is who are our partners, right? That's why I'm naming them. This kind of like gives you a little bit of push. This force that is giving the push is the money of traders coming in one direction, right? So money coming flowing in one direction is this momentum, and when this money kind of like flowing in one direction, this river stream starts popping up, you don't want to trade counter it for too long. Otherwise, you're going to be basically taken away or wiped away by this trend, by this force pushing and persisting in one direction. So this is exactly what happens with trading. And your job, or my job as a trend follower, as opposed to my mean reversion trader or momentum trader, range trader, is that I don't wait for divergences. I don't care if the market is oversold or overbought, because when the trend finally catches, it can stay oversold or overbought for years or for months, right? Just like it often does. So for this reason, I prefer to have a lower win rate of about 30%, maybe 3 out of 10 trades are going to be won on average. That means 7 out of 10 trades are going to be lost. And those 7 losses may come in sequence, one after another, right? So markets are chaotic. There is no rule. You don't know what's going to happen next. There is no way of predicting, okay, this and that day next month I'm going to make so much more money, or this and that amount of money, and not lose a single bit. That doesn't work like that, right? I wish it did, however, it does not. So for this very reason, I just wanted to kind of like bring up this point that, again, the patience, this delay gratification skill is going to be essential in applying the trend following systems, and it gives you so much time and so much flexibility to learn and to teach yourself to learn about your own behavioral biases and how to fight them on the cognitive side or on the emotional side. So that's enough about winning 200K in a month, because those pretty positive about that they're going to multiply and they're going to happen more often than not this year, especially when the market kind of like gets a little bit of tailwind eventually after persisting over 200-day trends for so many assets, just like stocks, risk-offensive stocks, consumer discretionary, which we're going to cover in a second, as well as cryptocurrencies. So the markets are positive. The pre-election years has, over the 84 years history, 83.3%, or actually still over this 84 years, over 84 years, last 44 years, there was only one instance that a pre-election year was just the way 2023 is, was actually off the record, off the bid, of the positive return. So historically speaking, over 84 years and even longer, the pre-election years have been the strongest players, have been generating the strongest returns, the best volatility, the most promising things were happening for the markets, for the risk assets overall, right? So we are in this good seasonal pattern, on the full contrary to what happened in 2022, as the midterm elections and the midterm years are the worst performing ones. And this is where typically the bear market either extends or it starts, in exactly the case we had last year, right? So especially after we have a down year before, which is the midterm, and it comes as a down year, this typically brings a huge recovery in 2023, empowered by this positive seasonality. So having a look into the charts, we are looking at the Dow Jones Industrials in the top section. Let me actually just turn it black here. And what can we see here is that there has been a little bit of attempt to break away higher over the symmetrical triangle pattern. However, those attempts have failed seemingly so far, right? And we don't necessarily know if it's going to sustain this way. However, what it means is, well, we know that for sure there is a little bit of resistance and a tailwind at the overhead level of around or above 34,000 points. So anything above 34,000 points have been kind of like wobbly, have been sold off clearly, right? So there is not much follow through, just like Dave Killer, CMT, my good friend, also commits. This follow through is essential, right? So it's not just enough to kind of like have this breakout alert, right? So that it triggers and then you bet on your portfolio on it. You don't. I know so many people who will go all in on their portfolio just buying on the breakout, and instead, it's better to wait for the retest, wait for a little bit of confirmation and a follow through higher and persists higher and makes new higher high in the same direction of the breakout. This is what confirms the actual validity of the signal and on this trend emergence. So, however, despite we've seen this significant shift in the market regime of a 200-day trend, this primary trend has shifted from the downside regime of the 2022 towards more kind of like horizontal. It's still declining, however, it's very slight decline. The market bottomed out in October, which historically is the perfect month for bottoming out for stocks. So this was just another confirmation to that thesis. And we've seen a little bit of again of forces, playing selling forces around 34,000 points. However, you can tell that there's been this significant breakout also on the transportational side, right? So the transportation is on the positive side. So it may happen that, first of all, whenever the Dow Jones industrials and transportation move along with an average, this is so-called principle of confirmation, as Dow theory would assume, right? So you want to see those averages kind of like move in the same direction. You don't necessarily want to see them move in the opposite direction. And because transportation is kind of like also reflected in the consumer discretionary, right? It relies upon the consumer discretion. It proves its cyclical nature, right? So whenever the times are good, whenever they have a lot of money, they could buy and reinforce the transportation. They could buy new cars. They could buy, just like Tesla or so, right? This is what typically increases the demand, and at the same time, on the financial markets, it pushes the prices higher because of increased demand of the buyers. So this thing tells me that we see a little bit of disparity in terms of the direction. New highs brought to the Dow Jones transportation. However, not new highs were made for the Dow Jones Industrial. So there's a little bit of divergence. There's a little bit of disparity. Those averages do not confirm each other so much, right, at this present moment. However, I would definitely take a little bit of transportation as a more of the leading indicator here. Typically, when it breaks out, it's driven by the cyclical nature. So this persisting higher industry tends to lag a little bit behind the cyclical stocks, right? So I would give it a little bit of benefit of doubt and see how it plays out, because eventually we are looking at the stop of the bear market in its old regime, strong declining thesis. We've seen decent double bottom reversal pattern in October last year, persisting higher over the 200-day trend with a solid breakout, and this breakout rejects to fall through the support. So it kind of like holds and maintains the support. That's what it tells me, and this is a bullish instance. So no matter kind of like this local noise, happening inside this environment, which is always so full of noise. Those movements are much more chaotic, are much more accidental, much more coincidental. So I would not kind of like assume too much, as long as it trades within the frames, within the this kind of like a pattern range, frames, resistance, support, range lows, range highs, whatever you name that. And instead, wait for the breakout, wait for the follow through, because eventually we see this breakout off from the leading indicator. So I would argue that on the relative strength side, we may see a little bit of push eventually, even after a little bit of pullback, because unless it fully breaks below 200-day average, towards like below 32,000 points, 32,300, then until that happens, or if it happens at all, only then I would be so much more cautious about this. Otherwise, the assumption, the look seems to be going upwards, right? So before we dive in to the S&P 500, the SPX large cap index, I want to get you a little bit of confirmation, guys, because you may see this beautiful tape at the bottom of the screen saying get our premium trading calls for free. And that is actually true, because in cooperation with our partners at Bybit, we agreed to make a great deal and a great offer for everybody who wants to come and learn and get those signals, just the one that I posted, for my trade, which gave $200,000 profit in just over a month. So you can get daily of those calls. We print daily of those calls, plenty of them. Some of them are automated. Some of them come from our amazing experienced people, traders who have been here for years, veterans, great veterans and great traders, great personalities that also from Twitter. We post every single day, plenty of calls, and those are the winning calls. Of course, you get a little bit of losses. However, if you stick around with us, this comes with profitability as a result. And since the very recent months, you can get that for the first time ever for free. We offer to you that with cooperation, if you deposit certain amount of money on Bybit, on an exchange with Bybit with our ref link, you can get our calls only premium calls only service for free for a month, for 4 months, or for an entire year. So if you want to get those premium calls for free at no charge, make sure you head over to the burbness.com/Bybit. And this is exactly what it triggers, right? So if we go ahead and type in the burbness.com/Bybit, what comes out is a little bit of instruction. And this instruction is going to tell you exactly what do you need to do to unlock specific, either 1 month or 4 months or even a year of calls only, right? Special benefits in cooperation with the Burb Nest, straight hour long and short calls with confidence. This is what we do. This is what we offer. And we say and offer in cooperation with our partners at Bybit that if you deposit $100 to receive, you're going to receive 1 month of calls only subscription, 30 days of free access to our premium calls that otherwise would cost you $1,428 a year, right? This is the yearly cost, and we give you that for free if you just deposit $100 with our ref link on Bybit. How cool is that? And you can benefit, with so many calls that we give out every day. And if you deposit, it gets even better, because if you deposit $10,000 deposit, then you not only get a special deposit bonus from Bybit itself as an exchange, but we also give you and grant you the role of 4-month calls only access for free, no charge whatsoever. This is promise, right? And it goes even deeper and further, because like I said, eventually you may acquire a year worth of $1,428 of calls only for free with up to $30,000 bonus on Bybit. So make sure you go ahead to the burbnest.com/Bybit to unlock, sign up with this link, sign up with our ref link, and as an exchange, in return, we're going to give you, we've set in deposit amounts. $100 gives you 1 month calls only. $1,000 deposit gives you 4 months calls only subscription. And this is it. You don't pay a single cent. Year worth $1,428. Well, tell me if it's worth it. In my opinion, it's a great trade for you, right? When you invest in your own education, this is the best type of investment that you can make. Even Warren Buffett, my favorite all-time investor, said the best investment you can make is an investment in yourself. The more you learn, the more you will learn. And I fully subscribe to it. I fully agree. And this is just to highlight, to give back to the opportunity to the community, because with more than 600,000 people, 650,000 people following me on Twitter worldwide, I want to give you guys as many chances and as many opportunities to go and actually just get something valuable for free. And this is it. This is the chance. So go ahead with the link on the bottom of the screen, at the bottom of the screen, theburbness.com/Bybit, and you're going to get access. And let's dig in deeper into S&P 500. So January barometer, over this past 72 years gave an 83.3% accuracy ratio. So it means that whatever happens in January, so goes the year, right? So as January goes, so goes the year. If January closes positive, the bullish year is supposed to happen. On the record, and this had been proven right with 83.3% accuracy ratio. So those are pretty good odds, right? Aren't they? So your job as a trader is to figure out on what to bet on, right? On what you want to bet the best. And if you have the winning rate of 83%, would you really counter trade that? Right? 83% of winning trades, if you actually follow through on the year, after whatever January result is. Last year, January was bearish, and it followed the bear market. And it was followed by a bear market. This time we closed a fully bullish year from the open 2023 all the way until February breakout. This was an inclining month and breakout above 200-day trend as well, which keeps declining just a little bit. So it tells me that even though the bear market kind of has shifted a little bit on the Dow Jones, it's definitely not there in its whole understanding, in its whole meaning. Here, the bear market kind of flattens out, so it's a little bit of a slower process. The breakout is a little bit weaker, however, making new highs, breaking above 4,100, which was the last year December's kind of highs. This has been a very significant round number undercore and a very strong psychological resistance. So this tells me that us breaking higher, the S&P 500 breaking higher, is eventually a positive sign. And even though there might be a little bit of, again, a little bit of pullback, a little bit of a potential headwind, like I said, with the stronger dollar, and a little bit of, exhaustion after positive move, like eventually the markets don't go straight up, right? They consist of from the smaller fractals of the small time frames. So those bigger tides, primary tides, consist of, even smaller movements, and those smaller movements, smaller tides, consist of even smaller tides, right? And even smaller movements, which eventually turn out to be noise, right? So you don't want to kind of like overtrade too small two time frames. You want to focus on where the trend is. This is what the beauty of the trend following is, giving you this exposure to very following the trend, and this trend continues to decline, right? So it's well, the very early signal of a breakout and a follow through, which is essential to validate the bear market breakout. It has been here. On average, over the past 200 days, you can tell that this kind of like impact of the recent breakout is not too kind of like powerful, is not too extraordinary, which tells me that there is a little bit of more headwind than when I just look at the Dow Jones chart, right? So the risk assets, the S&P 500, the risk stocks, big cap stocks, are moving slower or more slowly versus the industrials, right? Versus the industry. So industrial is improving faster. Cyclicals are even improving faster as the transportation is kind of like a little bit of consumer discretionary embedded as well. So it tells me that the big caps also slowed by declining earning reports, give a little bit of or experience a little bit of more headwind as they develop higher. However, the chart is constructive, the year is constructive, the seasonality is constructive. Only one mistake over 84 years for this pre-election years to be kind of like bearish, to be bullish, right? And only 1 year was bearish, as a matter of fact, was proving a mistake over 84 years of data. This is something extraordinary. This is very significant. So we have pretty good odds. We have significant breakout, early breakout. That's why I'm saying, it's an infant stage of a new bull market. The bull market is not there kind of like on 200-day average, which is an essential kind of like mark to start inclining first, right? But this early breakout in an infant stage is something that in fact may turn out to be a new bull market, right? So take it with a little bit of more of grain of salt than for Dow Jones Industrials or for Bitcoin, which I'm going to comment on very shortly. Hope it makes sense. Please let me know if it does make sense to you, everybody. And if we go further, then what we're looking at is the year-to-date performance chart for the S&P 500 sectors, right? And we can tell that there's been a lot of volatility, a little bit of declining kind of like tendency in February so far, right? So the February kicked off picking out, and following a little bit of decline for the consumer communication services. I wanted to say the green path communication services down from 23% to 16 or to 15% on the year-to-date performance. So a couple of percentage points, 6 percentage points, kind of like a decline, 7 even more. And so that we have consumer discretionary, which with a little bit of less of volatility, was declined a little bit less, and also performs at 16.7%, 0.07% on year-to-date performance, which is a pretty good return over, well, just a little over 30 days to the market start, right? The market actually had 28 days to date, so it's a pretty good performance if you ask me. And there's this significant shift. Like I said, this is why I'm calling this a bull market already, despite it's an infant early stage. It is because we have seen this significant shift, right? The market has shifted, and it shifted because the risk assets, everything that is on the upside, is performing as the risk assets, is everything, the type of sectors and stocks that should perform good during the bull market, and the stocks that should perform badly in the bull market are performing badly. So it's a full alignment, right? Theoretical meets the practical kind of like aspects to it. Energy is also starting to decline, which is a positive insight, because declining energy prices are eventually what lets you keep more money in your pocket, more disposable income on your hand, gives you opportunity to invest this money in expectation of future returns with the risk assets, right? With stocks, with Bitcoin, with other cryptocurrencies. So energy dropping is kind of like this hidden tax dropping as well, decreasing. It's a positive because eventually it may provide and turn out to give liquidity to where the market exactly needs it, right? So then you're looking at consumer staples at 3% down, healthcare 39% down, 3.4% almost, and 5.8%, 83. Utilities down on the year. So all the three or all the recessionary kind of like stocks, energy and consumer staples, utilities, those are following along with healthcare to the downside. This is positive for crypto assets. This is positive for risk stocks, for risk offensive strategies. And this is why I'm saying that this is a complete new shift and the market has rotated ever since the year started, 2023 started, and January kind of like reinforced with a bullish close. The market has shifted. It is a completely 180-degree different market kind of like rotation and situation that we had throughout the entirety of 2022. This is positive. This is why I'm saying that this is looking like a good start of something that we know as infant stage of a bull market, or if you know, a disbelief, right? If you were to put it somehow, anchor it, frame it on a chart. So if we are to go further, just like I said, we're looking at a little bit of this willingness, I would argue, then the XLE, the energy sector for the S&P 500 is kind of like looking like this potential double top scenario, right? Despite it's not necessarily confirmed just yet, right? Definitely needs to break above or break below 80, where the 200-day trend support is. Right, because eventually if it breaks to the downside, then we have an inverse situation to what we had as the bull market emergence, right? So an upside breakout after a declining 200-day trend triggers a bull market, and declining downside breakout after inclining 200-day trend basically confirms and validates an early stage of a bear market. So it's too early to confirm the energies in the bear market. However, there has been a significant shift after long-lasting period of inclines, and very significant inclines, right? All the way from, COVID 2020 at 1966, coming, you remember those negative oil prices, minus $30 for the futures, for the oil barrels. That was funny story. And inclining ever since, basically all the way to 86 or even at 94 approximately, area for the peakish times, right? So now we are kind of like moving inside this distribution pattern. You can tell that this descending, or should I say ascending channel kind of like broke down. It's retesting with a little bit of rejection just now after a significant slowdown and a failed breakout on top. This tells me that the chances are that we may actually rotate lower and follow through lower following the breakout to the downside below 80, 81 point territory of support defined by the 200-day trend, right? So why do I say it's a strong support level? Well, first of all, because this is where the market had bounced. This is where the market had respected, the significant level. It's also kind of like an approximate area to a round number. People love to frame their minds and anchor their minds at round numbers. It's kind of like makes the thinking processing, the thought processing easier to remember. This is where naturally people are going to anchor it, right? So traders are not going to, or less likely going to pick some random odd number, just like 81.1175. More likely they're going to kind of like try to frame their minds and with simplicity, parsimony, so that they kind of like get this closer approximation towards 80, towards 85, towards 50, towards 90, right? Those hundreds, those kind of like bigger rounded numbers are exactly where traders tend to behaviorally frame their minds and anchor themselves, to this. And this is also a little bit of self-fulfilling, right, effect to it, because if enough traders had look at it, that 200-day trend support is a good reflecting fair value, kind of like a measurement, then eventually the prices will gravitate towards this area and make it true, make it real. Hope it makes sense, right? So the big point is that if the energy market continues to decline, which seems to be kind of like more and more likely day by day, I would argue that this frees up more disposable income on your hands and stops draining money out of your pockets and giving you an opportunity and chance to invest where you actually want to invest and move from defensive sector, from protecting your capital to exposing your capital to risk to earn money. Hope it makes sense. Then we're looking at consumer discretionary relative strength ratio versus the consumer staples, which is yet another instance of what I mean as the market rotation. So the market is represented, the risk offensive side of the market, risk assets, risk on, if you will, is represented by consumer discretionary XLY. And the other side of the market, risk defensive, which is what performed the best during 2022, just like healthcare, consumer staples, utilities, they tend to perform good in the bear market and perform poorly, underperform in the bear market and in the bull market. So inclining ratio, relative strength ratio of XLY versus XLP tells me, well, that this divided prices of securities of XLY versus prices of security 2, which is the XLP, tells me that we broke above the 200-day trend. And like I said right before a minute, the early breakout over the 200-day trend following a series of declines over 200-day trend basis, is an early infant stage of a new bull market. So on the relative ratio side, this tends to precede the actual market action and show significant market rotation in favor of the risk offensive strategies. So for that reason, I would argue that it is yet another reason to reinforce the bullish thesis for 2023, because this is a long-term valid breakout. It's rejecting to kind of like decline and hide right back below this support, this resistance, or in fact, it turns now that this polarity has flipped as well, and this alt resistance turned into support as the market rejects to follow through or to follow lower. So without falling lower, the market is able to sustain faster or higher increases after a very sharp reversal and a failed bottom breakout, right? So this tells me there is a little bit of hope as well, and this comes like nicely with the communication services with technology. It's okay, also including the FANG stocks, right? Facebook, Amazon, Apple, Netflix, Google. And here's an example of a Netflix chart where the old objective of 330 bucks per share, following the May-ish Q3, somewhere bottom of the last year, half to bottom of the last year of the bear market, kind of like came up with a nice bottom breakout of the double top, kind of like following a little bit of consolidation, when the final early break in November or right after the stocks confirmed the bottom, being put in, in October early last year. This tells me, of course, that there is a little bit of persistence. There is decent persistence in the market, despite local turbulence, despite local, kind of like tides and noise. Remember that the markets are chaotic, right? So it doesn't need to respect a single line just because somebody draws it, right? It's going to kind of like move a little bit behind, a little bit further, a little bit lower, than it typically is assumed. However, it doesn't mean it's wrong. And in fact, it means that if it turns around those zones, not so much of lines, but think about it more as zones, areas, then this is where the true technical analysis comes in, right? So we're looking at this kind of like, resistances being formed, being broken, and they form the support regions, right? So I would argue that this chart is overall positive, especially that it also has started inclining on a 200-day basis for the first time since the start of 2022, or the end of 2021, if you will, which is where the bull market peaked, right? So this is a positive sign, encouraging also other assets, just like cryptocurrencies. But before we go to the crypto, this is a beautiful chart of RRG relative rotation graph representing these actual momentum curves. I hope it makes sense to you, because I had recently got this great talk with Julius de Campenauer, JDK legendary founder and innovator and inventor of the RRG charts, right, which represent two scales, two axes. One is the JDK relative strength momentum, and the other is relative strength ratio, and both are kind of like framed and anchored versus the S&P 500. So this gives you a full spectrum of the market rotation as it goes, right? And you can tell that there is a clearest market rotation representation that you've seen in a while. The reason is that we have basically nothing kind of like moving into the leading quadrant and into the lagging quadrant. So this tells me, typically, first of all, when you have a leading quadrant, you want to be overweight. Your portfolio should be overweight to the longs on the leading, right? Which is both improving on the relative strength momentum, which is gaining on strength and it's very strong, already trading in a relative strength, in a relative uptrend, versus the S&P 500, which sticks at the lies right at the interception of 100 and 100 x's. So anything that is inside leading quadrants should be overweight in your portfolio. You should be exposed to it, as those trends tend to persist, and because the momentum principle on the relative strength ratio says that if the outperforming assets will continue to outperform, right, and the underperforming assets will continue to underperform. So for this reason, you want to be overweight anything that is in the leading quadrant and underweight, which is an economic equivalent of a short position. You don't need to be short per se, you just can have less of this and it's going to work just as a short, of the liking quadrant. And yet we have nothing in those presently. Everything such as XLC, XLRI, XLRE, which is the real estate, or REITs, anything that regards our interest rate sensitive market of the real estate, XLY, XLK, also XLU, which is a little bit of kind of like reminiscence of the defensive stock, which is had this hook turn, kind of like moving towards the lagging quadrant. This tells me that this is a market rotation, right? As the market steps away from the basic materials, industrials, financials, healthcare, consumer staples, or energy, right, which had been the best performers basically over 2022 most of the time. So this is the market rotation. The market rotates from the improving quadrant towards leading, from the leading towards weakening, from the weakening towards lagging, and so on, right? The market just rotates, and as far as I can recall, there is a 90% of statistical chance, 90-0, this is 90-90, not 19, that the market is going to rotate to the next quadrant, right? To the quadrant on the right. So leading clockwise. It typically looks like that. And if we kind of like scroll it for the, or just review it, you can clearly tell for how nicely it looks, right? From the risk off sequence towards risk on, you can tell that the market clearly rotates and it moves clockwise. This is what I would argue as a good representation of what I'm exactly sharing for you to understand, right? That this is a market rotation. The market has rotated. The market has shifted technically, not on the outside. On the outside, of course, yes, this definitely impacts, the monetary policy. We have still, potentially some rate hikes going on to be had in the future, right? As the recessive impacts are yet to be felt. However, most of the damage seems to have been done. And besides, the stock market is kind of like, future vehicle that traders price in their expectations of what the future will be. So the prices you see, the price movements you see in the charts of stocks, of Tesla, or of Netflix, or on Bitcoin, it doesn't represent its actual current state. In fact, it tells you more about what the traders expect to be in the future, right? The price trends and narratives the price trends are driven by narratives, are driven by their opinions, and are driven by their hopes and fears, by the expectations of the future returns. If they fear that they're going to lose money, they're going to sell before it happens, right? So this is all kind of like processes, mechanisms also bring a self-fulfilling effect to it just a little bit. Hope it makes sense. So now, having most of these points connected, we know that Bitcoin has recently kind of like just had this positive bullish crossover that we know otherwise as a bullish golden cross, right? 50-day average crossing above the 200-day average. And this hadn't happened in a bullish manner until 2021 mid for the fourth quarter, if you will, right? So ever since the last signal prior to the current bullish sign was a sell signal, that exactly shows how well the trend principles work, right? Those trends, the trend breakout signal, just lasted for over a year. This is example of what can happen when you follow the trend. When you follow the trend, you would have sold Bitcoin around $50,000 and waited and all until now, right? Which it would have saved you basically from complete financial ruin. So I would argue this is a positive sign. We may get just a little bit of what we had early 2020. It doesn't necessarily, of course, need to look like this. In fact, the future doesn't, the history doesn't repeat. It often rhymes yet, right? So I would argue that this is a positive sign. Bullish crossover is a positive sign. Avoid magical thinking. However, do not expect that just the moment the signal comes in, the market will start pumping and it will not stop until the bear market comes up. Right? The market never moves in a straight line. It's going to be full of noise. It's going to be full of kind of like fake breakouts on the way. However, the bullish narrative is there, right? I know that some people referred also to this kind of like a bearish gold, or what do you call that, the death cross or something, right, over the weekly chart. This is a 50-week average crossing below the 200-week average, and people are fearing, kind of like deciding which is more important: the bullish cross on the daily, the 50-day average breaking above 200-day average, which gives more signals, of course, historically, or the 50-week average crossing below the 200-week average. So the answer is that you should probably favor the daily chart, right? Because of one reason, and the reason is the lag. On the weekly chart, you have only had one instance of the signal in Bitcoin's history. One signal. So you have no idea if it's bullish or bearish because it never happened like that. It may be bullish, right? Like, who says otherwise? You have no proof to claim otherwise. It may be well bullish, it may be neutral. You have no idea because there has not been an instance like that before. So that's one thing. And another thing is that the weekly chart comes, weekly signals come with great lag, and there's too much lag because those markets will get confirmed, will get their, this is basically confirming the bear market after it happened, a year after it started. Right? So the signals in the moving averages are not kind of like leading so much. They are representing of what had already happened. So this bearish cross is basically telling you that some time ago in history, the bear market happened. That's the way you should interpret it. It's not having this forecasting nature, right? Because before the signal triggers, it had already well happened, right? So there is no reason to claim it's bearish because it had only happened once in history. So there is no statistical sample data on that. It may well be bullish. You never know, right? You just have to look into data. But you're not going to look into data because it's not existent. You cannot just have a look into that. Otherwise, the weekly chart signals give too much lag to consider it meaningful, right? So it just confirms and reassures that, just like lagging indicators, it's lagging, right? Just like lagging indicators of the economy, just like whatever kind of like you want to imagine, like some unemployment, right? So unemployment happens or spikes up after it basically kind of like just had followed the recession and the companies closed off, if you know what I'm saying, right? So there are lots of leading coincidental and lagging indicators, and for Bitcoin USD's weekly chart, the moving average crossover of a 50-week average crossing below the 200-week average is a lagging indicator, right? And it just reassures that some time ago in the past we had a bear market. No shit, Sherlock, right? So that's it. That's the way you should look at it. And in fact, there is much less lag and much more meaningful signals, of the past, with many more instances of those signals in the past. So you can draw statistics, you can have certain conclusions over the statistical data, and which typically tells you that this is a pretty good and well-performing strategy for buying every time it crosses to the upside and selling every time it crosses to the downside. It's a winning strategy, right? Hope it makes sense. We're slowly getting close to our closing of the webinar, so I hope you enjoy that. If you're watching that on YouTube, make sure you hit the subscribe button, smash the likes, hit the notification bells, and leave some comments if you have any questions. I'll do my best to go and read them through and answer them, as well as my team. So just don't forget that, right? You can get us. I can get a full loads of valuable content, insights, and market education at accredited level. This is to remind you that I am the only CMT charter market technician charter holder from Poland, from my home country. There are only 3,000 people on the planet that have this accreditation, and this is exactly the type of knowledge and the quality of the insights that I'm giving to you, that you can benefit and learn from for free. Hope it makes sense. So back to Bitcoin, right? And other cryptocurrencies. While having a look at the Ethereum, you can tell that Ethereum is kind of like, just holding up better than Bitcoin does, right? The Bitcoin broke below its recent lows at around, what was that, like 22 300s. So it's broken down. It's a decisive break. It's a strong break. Like I said, whenever the signal triggered, I closed in 200,000 profit. And here, Ethereum kind of like gets chopped up a little bit more, right? This is typical for trend following systems. Like I said, 70% of the time you're going to get chopped whenever the market turns sideways. However, when it finally breaks with a decisive break, you're going to be able to rally the trend, right across along with the trend and cash in all those amazing profits coming from this trend persistence, right, which is non-existent in this sideways environment. So it's good that it's natural that you get chopped in the sideways. However, if you follow this trend following signals from the BPRO, which is my personal trading system that I use, um, then you can make sure that those losses are small, and despite their frequent, they are small, right? And you just wait for the longer tails in the market to develop. You gotta wait through getting chopped just a little in the meantime. So then, if we have a look at this daily chart, from another perspective, from Bitcoin, it's literally approaching and hovering right above the 21,500, which is a significant breakout level on the prior kind of swing highs area of last year, right before the market bottom. So it technically has a chance to kind of just turn out to be a market rotation at that level or closer to that level. Otherwise, if we don't really make the support out of the old resistance here, then I would argue we may follow through lower towards an inclining 200-day trend of around $20,000. And again, round numbers, people love round numbers, love frame on anchored day minds and round numbers because they're easier to remember, they're easier to kind of process. There's just less complexity, right? And it makes your trading easier. So that's why lots of traders are going to naturally and subconsciously gravitate with their thoughts towards those levels. So it's either 21,500 or $20,000. And even if it gets to $20,000, just remember there is a little bit of volatility, markets are chaotic. So it happens that even though $20,000 is a support, it may happen that it's going to kind of fall slightly below and then just climb back above. So things like that are natural. It doesn't necessarily mean that the support is invalid. In fact, it just tells you that the market are chaotic. This is the conclusion, right? Markets are full of entropy, this coherent, inherent noise that you cannot eliminate that just shifts the market unpredictably over the time that you cannot expect it, right? So you should expect the unexpected. You should assume and start by realizing that you cannot predict the future. You cannot predict and guess the prices well all the time. They're going to move slightly below, slightly above your expectations. And yet, this is going to work in the long run. So, some local secondary correction throughout this massive 200-day breakout, that is the dominant tendency. The market has shifted. Like I said, the market has rotated. This confirms that even though there is this local pullback, local headwind, following a start of the February, it kind of just gave you a little bit of hope and a significant break of almost 60% rally from bottom to the top recently, bottom to the peak, closer. And it's just not so much surprise, that it's facing a little bit of resistance, a little bit of hesitation of traders, which often comes from loss aversion, right? If traders cashed in a nice back position, and rallied it for 50-60% of the rally, they're going to say, okay, I know there is this $25,000 resistance, so I better kind of layer up my, layer down and just ladder down my ask orders, my sells before this level happens, because I don't like losing, right? And I don't like missing profit. So this is the loss aversion bias. This is this emotional bias, one of the most basic ones that everybody just fears, right? The fear of losing, the fear of mistaking, the fear of losing what you actually currently hold. This is what triggers traders to drop and ask on order their asks, their sell orders, place them better, ladder them down below significant levels, much more often than not, right? So this is a $25,000 layer, and they're going to stack up their sell orders below that, which actually in turn forms this selling force cushion, right? The selling ceiling and the opposing forces around the price barrier. And this typically what kind of consumes and distributes the other side of the market, the buyers, and the weakened demand kind of just gives up a little bit of control to a selling side as the market rotates lower. So, but don't confuse that with a more important and more critical trend shift and rotation going on within this bullish seasonal consensus over the past 84 years, right? The pre-election years have always been the strongest, except for some unpredictable events like black swans that just prove the rule wrong. However, if you see a seasonal pattern that just performs for over 84 years, or the January barometer, which performs 60 out of 72 last years, positively ever since 1950, then 83.3% accuracy ratio, would you counter trade that? If you have 83% of chances of winning, would you bet in favor of it, or would you bet against it, right? Or if you, otherwise, if you kind of like, of course, we don't know the future. So it's the same like with the temperatures. If you think about that, right? It's the same like with temperatures. If you experience the bullish summer temperatures, let's say if you historically, the June or July was the hottest month in the year over the past 100 years or whatever, and it also gives you like 35 average, temperature in Celsius, then would it be wise to assume that all of a sudden it's going to be freezing in June or July, right? Well, that's exactly the same. You don't know the future, just like in the markets, we don't know the future, right? So if you say that, and if you bet against the seasonal patterns, if you bet against technical analysis because the history doesn't kind of like predict the future, then why would you not place your money where your mouth is and bet on negative temperatures in summer, right? That's exactly the same testimony. That's exactly the same rule. History doesn't repeat, but it often rhymes. So if you have a look at the seasonal patterns and the seasonal data, that January has always been the coldest month, or June has always been the warmest month, the hottest month, then would you bet against that? In the same way, if the 83.3% of accuracy ratio comes from the saying that as January goes, so goes the year. If January closes bullish, and it did, then 2023 is supposed to be a bullish year, coming with the 84 years of the pre-election data confirming to those years to be the strongest. Then would you trade counter it? Right? I hope that inspires you with a little bit of thought exercise, mind exercise, to answer yourself this question. The answer should be really obvious, right? It's not really worth trading counter such powerful trends, even though we cannot predict the future, right? So that being said, ladies and gentlemen, I want to say that I appreciate you tuning in for today's webinar. Before we go, just remember that those signals come from the trend systems, from the range trading systems we have, and post daily of those on our Discord, right? And they come each and every single day. We have plenty of those. We have really plenty of those. And you can go and trade with us, right? And this time recently with our partners at Bybit, you can get and unlock those calls, those updates generated automatically by our amazing bot or by our discretionary traders, coming with a full force, with a full strong strength for the legacy calls, for the crypto calls. There are plenty of those automated calls, automated signals from the BPRO with webinars and so on. You can get that for free if you just go to the burbnest.com/Bybit. If you go to the burbnest.com/Bybit, you can follow the steps and deposit $100 and unlock with our link the free month-only access to these channels, to these materials, to these resources coming with daily signals and automated signals. And if you deposit $10,000 eventually with our link, the calls only for 4 months is going to be yours. And eventually you can repeat that and stack it up, and the year worth of $1,428 worth of calls only premium subscription, you can get it for free without paying. You're not going to be charged a single penny for this calls only subscription. And you can get deposit $100 for 1 month, deposit $10,000 for 4 month calls only access. And if you go and follow that, then you can even unlock the year worth of $1,428 worth of calls only premium access, as well as $30,000 deposit bonus. How cool is that? Go ahead and sign up, try it out, sign up with the burbnest.com/Bybit with our ref link, and wait for validation, wait for instructions that are given and defined by Bybit. And you're going to get granted the access to our premium exclusive community that has been rolling since 2017. We've had bull markets, we've had the bear markets, we've had sideways, we've had black crashes, we have COVID, we have recession, we have everything. So we're still here, we're still running, and we're going to continue to provide you with the highest quality insights. Don't forget to hit the subscribe button, smash the likes, hit the notification bell so that you stay notified and tune in for each and every single show that we have running daily on our YouTube. That is free. And also, don't forget to hit theburbnest.com/Bybit. Go ahead and unlock your premium calls only membership for free. Just deposit $100 or $10,000 bucks to unlock one more for 4 months, or even more, coming up with up to $30,000 deposit bonus with our partners at Bybit. That's all, folks, for today. God bless you all. See you around, and see you in the Burb Nest.